Welcome to the Chartered Financial Analyst Level 1 series of videos. Today we will continue our discussion of the topic of corporate finance and equity, and this is the video number 14. In this video we will finish off the topic of cost of capital, and today we are going to discuss the issue of adding a country risk to the beta. What do we mean by that? When we calculate beta using data from the stock market of the international markets, such as the US stock exchanges, we calculate beta in that developed countries. But we must not add that immediately in evaluating a project in other countries unless and until we add what we call country-specific risk. How to do that? Let us jump into this topic. Are we going to add country risk to beta? Normally we don't do this when we use beta from the developed country, because beta automatically add the country risk into the data once you calculate it, and no further adjustment is required. But if we are going to use the same beta figure calculated using data from developed country, but we want to use it in developing countries, that is developed past tense and ing continuous, that means it's still developing, third world countries as they call it, we need to add country specific risk. Each country has its own risk. So how to measure the risk of country A or B or C? Definitely not all developing countries have the same type of risk. Some of them are more riskier than the other. So the best estimate to do that is to look into the bond issued by the government of that country. How much the bond pays, which normally should be higher than the developed countries because the risk is higher. For example, if in the USA the government bond pays 5%, I would expect in another developing country that is less developed than the United States, that means the risk is higher. In order for such country to attract foreign investor or prevent their own home country investor from going to US, is to pay them more than what the American market pays. If the market in USA pays 5%, we should pay 6%, 7%, 8%, depending on how risky the country is. What we call that? We call it country equal premium, which is the sovereign spread. What is meant by sovereign yield spread is the difference between bond issued by the government of developed countries and another bond issued by the government of developing countries. Definitely developing countries is higher. The spread is simply the difference between the two. Developing countries bond yield 7% minus the developed economies such as the US 5% will give the spread. The spread is always the difference between the two. How we do that? We multiply it by a factor. That factor is the sigma of the equity index divide the sigma of the sovereign bond in developed market. What does that mean? Sigma measure how risky is the equity market in the developing countries. Countries other than the US. In countries like less developed, they have equity market. That equity market is risky. How to measure its riskiness is using sigma. And what is sigma? Sigma, without going into complication of the calculation, because we'll come to this later, I just want to explain the basic idea of sigma. What is sigma and what does it measure? Sigma simply measures the risk of the equity market in that country. How? It shows how the market fluctuates from its average return or level. Let us assume that a country has index of 10,000 currently today. During the year, it goes up to 16,000 and it could go down up to 6,000. You can see it moved up 6,000, which is 60%, and it moves down 4,000, which is 40% out of the average of the 10,000. Compare this country with another country that have the same level today of its index, that is 10,000 points, but on average it moves between 10 to 11, and 10 it goes down to 8,500. That means it moves in a narrow way. In this way, its sigma will be smaller than the sigma of the first country, because that first country fluctuates sharply up and down. So it is very risky, and the sigma of that index will be very high. We will divide this by the sigma of the sovereign bond, that is bond issued by government of developed countries, which we should assume always that sigma will be very small, because developed countries are less risky. The government, the sovereign bond issued by that government, democratic country, stable political system, stable security issues, so there is no huge fluctuation. Normally this figure will be higher than this figure, and then you will get more than 1. If you get 1, that means by multiplying 1 into the spread, you'll get the same spread. But normally this result or the product of this division will be higher than 1, which leads to more than the spread. How to calculate the spread, as I mentioned, is the difference between developing countries' bond yield, government bond, that is sovereign bond issued by the US market, developing countries, not the developed countries, minus the developed countries US, which is normally smaller because of less risk in developed countries. If this is 7, this will be less than 7, the result will be positive. It will not be negative, because this is always, as I said, smaller. The product of this, we'll plug it here and multiply on this, we get a country risk premium. We add it to the beta, which is calculated based on a developed economies. And then we get new beta higher than the one that will be specific to the country where we intend to invest. Let us take a small example, which is a direct number. We plug the numbers. An analyzing company called GMC is estimating country risk to include in the equity calculation. It's trying to calculate the beta, which is a measure of risk of the equity, so that we can use it in the weighted average cost of capital to invest in a company called ABC, which is located in a country that is in a developing market. It's not in the developed market, that is the emerging markets. He has observed that the government 10-year bond gives 6.2%. But in the developed countries, such as the United States, the treasury bond pays only 3%. That means that the sovereign yield spread is 6.2 minus 3. 6.2 in the developing countries, minus 3 in the developed country of the United States, that gives 3.2%. The annualized standard deviation. What is meaning of annualized? We calculate it on a daily basis, the fluctuation in the index, but then we have to annualize it for the whole year. Standard deviation, that is sigma of the stock index of that country where ABC operate is 40%. We plug here 40%, and the annualized standard deviation of the similar bond of 10 years in a developed country is 20%. So 40% divided 28% times the spread of 3.2, 6.2 minus 3, that will give us the country equity premium, which we will add to beta. But in real life, to see how CFO would calculate the chief financial officers of corporate in United States and other country also, how they do it in real life. How do they calculate the cost of equity? As we mentioned in video number 9 of this series in videos, we went into a deep discussion of how to calculate the equity cost, which we do it using the capital asset pricing model, which we normally say CAPM. We use CAPM to calculate beta, and then we use that beta to calculate the cost of equity, which is risk-free rate of return plus beta time market risk premium, which is market return minus risk-free rate of return. Please go back to video number 9, which I'll put a link to that video in the description box. Go there and see how we calculate the cost of equity, and then come and compare this with a survey that has been conducted in the United States with chief financial officers. These are 2 researchers. They ask the CFO question about how they do it. How do in real life they calculate the cost of equity? Do they use the CAPM model or other model which we discuss in this series? The result is like this. Most popular method of estimating the cost of equity, as I said, is the capital asset pricing model, CAPM. And this is widely used, especially with sophisticated companies, well-managed companies, big companies like Apple, Microsoft, Google, all these big sharks. They use the CAPM to calculate the cost of equity. There's some companies use the dividend cash flow model. That is, if you remember the golden rule, I forgot to bring it here. It is cash divided required rate of return. Always the value, cash divided cost of equity. Now the dividend cash flow model is the dividend divide the required rate of return. That will give the price. So we can rearrange the formula and get the cost of equity by dividing the dividend payment made by the company by the price of that company shares. In this way we get the cost of equity. Very few companies use this because dividend keep fluctuating. Also the share price in the market keep fluctuating frequently. So it's not a reliable way. This is why only few companies use that method. Publicly traded companies that is listed in the stock market are more likely to use the CAPM. As I mentioned, big sharks in the market, they use it. But private companies don't normally because they don't have the expertise staff or CFOs. They use I won't say not qualified, but less qualified than big companies. This is why private companies normally use small method or estimate, just sometimes they call it random estimate of the cost of equity. Especially private companies don't have similar companies in the market, and it's very difficult to tell whether a private company is similar to a public company. And finally, in evaluating projects, the majority use a single company cost of capital. But a large portion applies some type of risk adjustment for individual projects. What that means? Normally the company knows its cost of capital. If it's going to a new project, The survey reveals that the majority use the same cost of capital, but very few a large portion applies some type of risk adjustment. That means they will say, okay, our cost of capital is 10%, for example, and now we are embarking in a new project. That project is a little bit riskier than our company because the cash is uncertain. There is some legal issues surrounding this project we might face in the future. Litigation, maybe environment pollution in that area. There is some activists. There's so many factors to consider. So let us use 11% or 12%. That means we adjust based on the project specific risk as perceived by the Chief Financial Officer. With this, we come to the end, and in the next video, video number 15, we will start a new topic, because I just mentioned video number 14 is the last video on the topic of cost of capital. Next, in the video 15, we will start a new topic, which is very interesting, the topic of leverage, how we are measure leverage, and how do we define leverage. There are two types of leverage, that is operating and financial leverage. That means we have operating leverage and also we have financial leverage. We know what's the difference between the two and how to calculate each. Also, we'll discuss the difference between the business risk and the financial risk and how to measure each of them. And finally, we go through a numerical example. And as usual, please do subscribe to the channel so that you get notified whenever I publish a new video.